Welcome to BD Daily Finance News Podcast for the 22nd of November 2025, your daily briefing on markets, the economy, and investing. We've got a packed 20 minutes today. AI bubble fears despite Nvidia's monster earnings, under-the-radar chip plays, a spike in silver volatility tied to Fed policy, Italy's first Moody's upgrade since 2002, a tough setup for U.S. retail stocks into the holidays, energy and data center risks in Texas, and fresh stress across crypto and Bitcoin.
Overnight, equity markets were choppy. U.S. stocks staged a late-session comeback with the S&P 500 closing roughly 0.8% higher after being down more than 1% intraday, while Bitcoin extended its slide, dropping another 5% and now sitting more than 20% below its October record high. Rate expectations also moved, with futures pricing about a 70% chance of a Fed rate cut in December 2025 after dovish comments from NY Fed President Williams.
So we've got a market that's trying to buy the dip in stocks while clearly de-risking in crypto. We'll connect those dots later, but let's start with the story that's been driving everything all year: AI. Segment 1. This week in AI. Nvidia just posted another blowout quarter, yet AI stocks still sold off, and bubble warnings got louder. CNBC and other outlets highlighted that despite Nvidia beating on both revenue and earnings, volatility gripped the AI trade. Walk us through the numbers and the market's reaction.
Nvidia's quarter was remarkable. Revenue once again surged at a triple-digit year-on-year pace, and guidance pointed to continued strength in data center AI chips. Yet instead of a clean rally, we saw intraday swings of several percentage points, and broader AI baskets underperformed. The reason is positioning and narrative. After such a long run, investors are hypersensitive to any sign that AI capex is peaking or that regulation and competition could compress margins.
There's also this sense that every incremental good news event is needed just to keep valuations where they are. We've seen commentators call this an AI bubble that keeps inflating. How much of the volatility this week was simply profit-taking versus a real rethink of the AI trade?
It's a mix. Short-term, a lot of it is profit-taking after Nvidia's earnings. Some traders use the strength to lock in gains. But under the surface, volatility is signaling that investors are starting to differentiate. The everything AI bid is fading. We saw that in the fact that Nvidia's strong print didn't steady the broader market. Indices tied to AI actually underperformed even as the company delivered. That tells you sentiment is fragile.
For someone listening who maybe owns a broad tech ETF that's heavy on AI names, what's the practical takeaway from this week's action?
The key is time horizon. If you're a long-term investor, Nvidia's results reinforce that AI demand is real, not hype. But you should expect more weeks like this: big intraday swings and sharp rotations. That argues for diversification within tech, not just crowding into the same mega caps, and for being disciplined about position size, so a 10-15% correction in AI doesn't derail your overall plan.
That sets us up nicely for segment 2, the under-the-radar chip stories. One of the higher-scoring pieces in our feed today highlighted Credo and Astera Labs as chip names that could deliver rapid sales growth over the next 2 years. The point was that Nvidia isn't the only game in town. What stands out about these smaller players?
These companies sit in the plumbing of AI and high-speed data. Credo focuses on connectivity solutions. Think high-speed SerDes and active electrical cables that move data efficiently inside data centers. Astera Labs builds connectivity chips and systems that help link CPUs, GPUs, and memory. Analysts are looking for very strong top-line growth, potentially outpacing the broader semiconductor sector over the next 24 months as AI infrastructure build-out continues.
So these are leverage plays on the same AI capex theme, but without the mega-cap valuations. What are the key risks investors should be aware of before they start buying every AI-adjacent chip ticker they see on social media?
The main risks are customer concentration and cyclicality. Smaller chip firms can be heavily dependent on a few hyperscalers or OEMs, so a delayed order or design change can hit revenue hard. They're also more exposed to inventory cycles. If the AI build-out pauses, their sales can swing more than those of diversified giants. And valuations, while below Nvidia, still embed strong growth assumptions, so any disappointment can mean sharp drawdowns.
In other words, interesting names for a watch list, but size them like growth stocks, not bond replacements. Let's pivot from chips to metals, because policy expectations are hitting that space hard. Segment 3. Silver's surge in volatility. One of today's pieces flagged a time of higher silver volatility as markets react to a potential Fed policy shift, with investors betting on a December 2025 rate cut. What's actually happening in silver right now?
Silver has been whipping around as traders recalibrate for lower rates. Dovish signals like Fed officials suggesting policy is in the right place, and futures pricing roughly a 70-73% chance of a December cut, have pushed real yields down at times, which is supportive for precious metals. But the path hasn't been smooth. We've seen intraday swings of more than 3% in silver as bond yields and the dollar react to every data release and Fed comment.
Silver is always more volatile than gold, but this feels elevated even by its standards. For a retail investor who maybe added silver as an inflation hedge, how should they think about this environment where the Fed may be easing while inflation is still not at target?
Silver is a hybrid, part monetary metal, part industrial metal. Rate cut bets help the monetary side, but slowing global manufacturing can hurt the industrial side. That's why volatility spikes. If you hold silver, consider it a tactical satellite position, not a core holding. Use position sizing and maybe staggered entry points instead of trying to time every move off the next Fed headline.
You mentioned Fed officials. Another item in our feed cited Boston Fed's Collins, saying monetary policy is currently in the right place and that she's hesitant about cutting rates too quickly. At the same time, we've seen commentary around NY Fed President Williams helping swing December cut odds back above 70%. How is that tug-of-war playing out in FX, especially EUR-USD?
EUR-USD has been stuck in a relatively tight range, with some analyses describing it as a mean reversion environment inside roughly a 2,000 pip band over a longer horizon. Recent dollar strength on hawkish repricing has been offset by those more dovish Fed comments. Euro area data show business activity holding up, especially in services, but wage growth disappointed at around 1.87% year-on-year in Q3, which keeps the ECB cautious. So FX traders are essentially oscillating between US and European central bank narratives rather than betting on a clean trend.
So for listeners trading currencies, the message is fewer big trends, more range trading, at least for now. Let's stay in the macro lane but head to Europe, where Italy just got a rare piece of good news. Segment 4. Italy's first Moody's upgrade since 2002. One of the standout headlines today was that Moody's has upgraded Italy for the first time in more than 23 years, a political win for Prime Minister Meloni, and a relief for investors who worried about a slide toward junk status. How significant is this move?
It's quite significant. Italy has long been seen as one of the euro area's key credit risks because of its high debt to GDP ratio and low growth. The fact that Moody's is moving the rating up, not down, signals that near-term default risk is perceived as lower. It also widens the margin above junk, which is critical for many institutional investors who are constrained from holding sub-investment grade sovereign debt.
We also saw ECB President Christine Lagarde in the news, stressing that monetary policy can't solve debt problems, implicitly pushing back on calls for renewed large-scale asset purchases. How should listeners connect those two threads, Italy's upgrade and Lagarde's message?
Lagarde is reminding governments that they can't rely on the ECB's balance sheet to fix structural fiscal issues. Italy's upgrade suggests that, at least for now, markets believe Rome is managing its debt well enough without extraordinary ECB support. For investors in Italian bonds, that can mean narrower spreads versus Germany and potentially lower funding costs for Italian banks and corporates. But it also means future fiscal slippage could be punished more quickly if the ECB is less willing to intervene.
For a diversified bond investor, does this change anything tactically? Or is it more of a slow burn story to watch over the next couple of years?
It's mostly a slow burn story. If you already hold euro area bond funds, you likely have some Italy exposure baked in. The upgrade slightly improves the risk profile of those portfolios. Active investors might look for opportunities when spreads widen on political headlines, knowing that the underlying rating trend has turned more positive, at least for now.
Let's come back to the US and talk about the consumer. Because one of the more sobering headlines in our feed was that retail stocks need an unlikely holiday miracle to save what's been a rough 2025. The piece described the American consumer as limping into the holiday season. What's behind that characterization?
We've had a long stretch of elevated prices, higher borrowing costs, and fading excess savings. Even though wage growth has been decent, it hasn't fully offset the cumulative impact of inflation. Retailers are seeing softer traffic and more price sensitivity. Some segments, like fast casual dining, have already reported falling same-store sales, and now general retailers are signaling cautious guidance for the holiday quarter.
We also saw a piece on the so-called bowl boom being over Chipotle, Kava, Sweetgreen, leaning on promotions and loyalty perks to lure Gen Z back. That's very consistent with what you're describing. The consumer is trading down or waiting for deals. For investors holding retail ETFs or individual names, what should they focus on into year-end?
Focus on balance sheets, inventory discipline, and pricing power. Companies that kept inventories lean and have strong loyalty ecosystems can use targeted promotions without destroying margins. Also, watch management commentary on January and February if they talk about pull-forward demand into the holidays. That can mean a softer Q1. For long-term investors, this is a stock picker's market within retail rather than a broad beta trade.
And for listeners on the personal finance side, this is another reminder. Retailers are under pressure to get you to spend. Having a budget for holiday shopping is as important as ever. Let's switch gears to a story that sits at the intersection of tech, power, and risk. Texas data centers. Segment 6. Texas data center expansion and blackout risk. One report in our feed warns that Texas's supply and demand balance can become tight during winter and potentially fall into deficit as data center demand grows. What's going on here?
Texas has become a magnet for data centers, including AI-focused facilities that are extremely power-hungry. At the same time, the state's grid has already been tested by extreme weather, as we saw in prior winter storms. The analysis suggests that as new data centers come online, baseline electricity demand rises, leaving less margin during cold snaps. That increases the risk of tight conditions or even localized blackouts if supply can't ramp quickly enough.
This is another knock-on effect of the AI boom that doesn't show up on a simple earnings chart. For investors, how material is this? Are we talking about risk to utilities, to data center REITs, or is it more of a policy and infrastructure story for now?
Right now, it's mostly a policy and CapEx story, but it can become an earnings story. Utilities may need to invest heavily in generation and transmission, which can pressure near-term free cash flow but grow the asset base over time. Data center operators could face higher power costs, curtailment risk, or the need to co-invest in on-site generation and storage. For investors in those sectors, it's worth reading management commentary on grid reliability and long-term power contracts, especially in concentrated regions like Texas.
So, the AI story again bleeds into real assets and utilities. Let's turn to another area where volatility has been intense. Crypto. Segment 7. Crypto's brutal month and Bitcoin as a warning signal. One article in our feed framed the latest crypto slide as a stress test for Wall Street, and another argued that Bitcoin's sharp drop from its October record high is now a crucial barometer for broader markets. Bitcoin is down more than 20% from that peak and kept falling even as U.S. stocks bounced. What does that divergence tell you?
It suggests that the most speculative corners of the market are de-risking more aggressively than mainstream equities. Crypto has always been more volatile, but when Bitcoin fails to participate in an equity rebound, it can be an early sign that liquidity conditions or risk appetite are deteriorating beneath the surface. The article you mentioned described moves in Bitcoin as an early alert that markets are unwell, and the current pattern fits that narrative.
We also saw headlines about crypto treasuries looking to move beyond simple HODL strategies, seeking yield, hedging, even share buybacks as discounts to net asset value widen. That's a sign of stress, too. For a listener who holds a small allocation to Bitcoin or crypto ETFs, how should they interpret this month's pain?
First, remember that 20-30% drawdowns are common in crypto, even within broader bull cycles. Second, the fact that listed vehicles are trading at NAV discounts and exploring yield strategies tells you that the easy phase of the trade is over. If you hold crypto, it should be a small, high-risk sleeve of your portfolio, with the understanding that it can be a leading indicator of stress, but not necessarily a timing tool for equities.
And for anyone tempted to go all in because prices are down, that Market Watch-style cautionary piece, watch out. Bitcoin isn't what you think it is worth internalizing. Volatility cuts both ways. Let's bring in one more crypto-adjacent story before we zoom out. Regulation. Segment 8. Banks, the OCC, and the IRS. We had an OCC release this week, confirming that U.S. banks have authority to hold certain crypto assets as principal under defined conditions. And separately, a new IRS reporting requirement starting with the 2025 tax year will make some popular crypto tax strategies much riskier. What's the big picture here?
The OCC guidance is a step toward integrating crypto more formally into the regulated banking system, but with strict risk management and capital rules. It could eventually expand institutional custody and trading services. On the IRS side, the new rules will require more detailed reporting of crypto transactions, reducing the ability to use informal or aggressive tax law strategies. For investors, it means you need better record keeping and should assume that crypto gains and losses will be more visible to tax authorities.
So regulation is slowly catching up, making crypto feel more like traditional assets in terms of oversight, even as price behavior remains anything but traditional. Let's squeeze in one more macro market segment before we wrap: the weekly outlook and why this close matters. Segment 9. Why this weekly close matters. One of the commentaries in our feed noted that U.S. stocks endured a rough week, despite strong earnings from names like Walmart and Nvidia, with sentiment hurt by fears of peaking AI investment, a topping labor market, and tariffs biting the consumer. It highlighted that after about a 2% weekly drop, the close is critical. A breach of October lows would confirm a breakdown. A rebound would suggest more range-bound frustration. Where are we as of today, the 22nd of November 2025?
As of the latest close, major U.S. indices are still above their October lows, but not by a huge margin. The late-week rebound you mentioned, around 0.8% on the S&P 500, helped, but breadth has been mixed. Rate cut odds near 70% for December have supported risk assets. Yet the combination of AI fatigue, consumer strain, and political noise around tariffs keeps volatility elevated. If we hold above those prior lows into next week, the base case remains a choppy, range-bound market rather than a decisive bear leg.
For someone managing their own portfolio, does that argue for big tactical moves right now, or more of a check your allocations and stay disciplined approach?
For most people, it's the second. This is a good time to rebalance if AI, tech, or any other hot sector has grown far beyond your target weight, and to make sure your cash and bond allocations still line up with your risk tolerance. Trying to trade every headline about rate cuts or tariffs is hard even for professionals. Having a plan for what you'll do if markets break those October lows is more useful than guessing whether they will.
Before we close, let's tie a few threads together for listeners. AI volatility, silver and Fed expectations, Italy's upgrade, the limping U.S. consumer, Texas grid risks, and crypto stress. If you had to give one overarching message for the 22nd of November 2025, what would it be?
The common theme is that we're in a transition phase. The easy narrative's AI only goes up, the consumer is endlessly resilient, crypto is an uncorrelated hedge, are being challenged. Policy expectations, from Fed cuts to European ratings to U.S. tariffs and regulation, are driving cross-asset volatility. For investors, that means leaning into diversification, being realistic about risk, and focusing on quality balance sheets and cash flows rather than chasing the most speculative stories.
Let's recap today's episode. We started with Nvidia's blowout earnings and growing AI bubble fears, noting that while demand is real, volatility is here to stay, and investors are finally differentiating within the trade. We highlighted smaller chip names like Credo and Astera Labs as potential high-growth beneficiaries of AI infrastructure, but with concentrated risks. We then moved to silver, where heightened volatility reflects a tug-of-war between Fed rate cut bets and a mixed global growth backdrop.
On the macro side, we covered Italy's first Moody's upgrade since 2002, and Lagarde's reminder that central banks can't fix fiscal problems alone, a positive but conditional signal for euro area credit. In the U.S., we discussed a struggling consumer and retail sector heading into the holidays, the end of the fast casual bull boom, and how Texas's data center-driven power demand is creating new grid risks. Finally, we examined crypto's brutal month, Bitcoin's drop of more than 20% from its October high as a potential early warning signal, and the tightening regulatory net from the OCC and IRS.
If you're listening on the 22nd of November 2025, your action items are simple. Review your tech and AI exposure, make sure your overall risk level matches your time horizon, and don't ignore the signals coming from metals, credit, and crypto. Use weekends to plan rather than react. And as always, nothing in this show is personal financial advice. Talk to a professional who understands your specific situation before making big moves.
If you found today's breakdown helpful, we'd love to hear from you. Let us know which segments you want us to go deeper on: AI infrastructure, silver and metals, European credit, or crypto regulation. Your questions help shape future episodes.
You've been listening to BD Daily Finance News, podcast for the 22nd of November 2025. Make sure to subscribe, leave a rating, And share this episode with a friend who's following markets. We'll be back tomorrow with another concise rundown of the stories that move your money. Thanks for joining us, and have a disciplined investing day.